Good afternoon, everyone, and welcome to our Public Sector Quarterly Performance Review webcast highlighting the results from our recent Public Sector IT Services benchmark. My name is Allison Crawford, and I'll be your host for today's session. Over the past few quarters, we've engaged with our readers to bring deeper clarity into the state of the public sector market. We've had good questions and discussions as a result of these events, and we're excited to continue to connect with you as the public sector practice grows. In this presentation, Senior Analyst John Caucis will delve into the trends driving the results featured in this quarter's benchmark, followed by Q&A of these trends and how they will affect you. First, we'll be recording today's session and posting it on our YouTube site, TBRI channel. We encourage you to visit our channel to watch this presentation or any of the others we've posted. Second, we'd like to hear your opinions and thoughts on the materials we're presenting. Please send any questions or comments to the Q&A or chat function to the right of your screen. John and Sebastian will address them at the end of the presentation. Or if you'd like to set up a client inquiry for more detailed discussion, please reach out directly to the analyst to set up that conversation. Third, we'll send out the slides to everyone registered for today's webcast within 24 hours of the conclusion of the webinar. You can also find slides as well as other thought leadership decks, webinar decks, and commentaries on SlideShare at www.slideshare.net/TBR_market_insight. And I'll share the social media links with you at the end of the presentation. With that, let me introduce John Caucis, Senior Analyst and Public Sector Practice Manager, and Analyst Sebastian Lagana, Lead Author on the Public Sector Company Reports and Benchmark. John has been analyzing the market for the past 10 years and is TBR's resident expert in the government sector. Sebastian has spent the last 24 months immersed in the strategies of government vendors to uncover patterns and trends unavailable anywhere else. John and Sebastian's research has been critical in the planning of black hat strategies for several of our clients, and their insight into the performance of the government vendors has enabled several of our clients to identify new opportunities and revenue streams. And with that, let me turn this over to John.
Thank you, Allison, and thanks for joining us today. I want to take a few minutes to provide the audience with some background information regarding our research approach and methodology in the Public Sector IT Services Research Program here at TBR. First of all, we follow on an ongoing basis about 20 vendors in our Public Sector IT Services practice, and of these 20, we publish quarterly and semi-annual reports on 16 of the companies. Specifically, we report on 9, as we call them, government-centric companies. That is, companies whose primary customers are government or non-commercial entities. We also track the public sector activities of 7 leading IT services companies who, while operating predominantly in the commercial sector, do have a large enough presence and play in the public sector to warrant coverage by TBR. And then finally, we include quantitative and qualitative analysis of 4 additional government-centric firms in the quarterly benchmark report. Those you can see listed here as Harris, Boeing, MCI, and ITT Excelis, though we do not yet publish syndicated reports on these firms. As these vendors are also amongst the leading government IT services contractors, we've included them to provide a broader view of the public sector and the market forces impacting the government-centric IT services firms. So with that, I'd like to jump into the presentation and take a few minutes and talk about where we're going to go today. And today I'll discuss 3 primary themes that emerged from our public sector IT services research for the second calendar quarter of 2013. First, I want to talk about the impact of the sequester, and the impact that we observed primarily on the growth and backlog metrics of the benchmark vendor group in particular. We'll call out some of the trends with respect to backlog. Then from there, we'll drill down into margin performance, which was an area that began to emerge this quarter as another primary area on in terms of financial performance where companies were seeing an impact from the conditions, in particular the sequester in the federal IT services space. And then finally, we'll conclude by looking at actions that companies are taking in response to the challenges and opportunities that they're finding in the environment, and I'll provide some comments about the outlook for the remainder of 2013. So let's begin with a brief review of a handful of key financial metrics, as I mentioned, revenue and backlog, from our benchmark study and how the conditions in the current public IT services environment, in particular the sequester that was triggered on March 1st, have impacted vendor fiscal performance. So let me take a moment to orient the audience to the graphic on this page. The blue line here represents the average total year-to-year growth for all 20 firms in the benchmark IT services, the public sector IT services benchmark study. The red line also represents average year-to-year revenue growth, but is calculated on a trailing 12-month basis for the benchmark firms in order to smooth out the impact of seasonality. Both averages are weighted to account for the size of each benchmark firm's respective revenue base in the public sector. So after what was a short-lived and modest increase in the total growth rate earlier in the year, in the first calendar quarter of the year, the downward trend in top-line growth resumed in 2Q13. The same core drivers that have essentially been resident in the federal space since 2011 remained in place and remain the primary headwinds to revenue expansion, that being budget constraints, long-term contraction in program scope, procurement delays and terminations, extended business development cycles, and just an overall decline in immediate IT spending volumes. Sequestration was the biggest news of the first half of the year. Was essentially triggered in the last month of the first quarter, and we started to really see the impact during the second calendar quarter of the year. And the impact of the mandatory budget cuts are primarily being felt in the form of decelerating growth rates that we have illustrated here, not just in the second quarter, but we've also provided our outlook for the remainder of the year, and we believe that the steady deceleration in growth rates that you see here is going to be caused primarily by the impact of the ongoing budget turmoil, sequestration, the continuing resolution environment, et cetera. And back in the first calendar quarter of the year, we did caution that we had some clients and some other companies approach us and say, well, does this acceleration in growth rates, albeit it was still negative, does this represent an inflection point in the market? And we cautioned that in our presentations last quarter that we didn't believe that the acceleration of growth rate should be interpreted as the beginning of a market recovery. We knew that sequestration was more than likely to happen. We had received guidance from many of the companies in our benchmark study, and all of those factored together really pointed to a difficult year for most of the companies in our benchmark study. So with that, I'd like to move to the next slide. So while sequestration emerged as a factor in company top-line performance, we also saw the impact clearly discernible in terms of company backlogs. What we have illustrated here on this slide are the total backlog levels for the government-centric firms, the 13 government-centric firms in our benchmark study for the second calendar quarter of 2013, and the sequential change in their respective backlog levels from the previous quarter, from the first calendar quarter of the year. And we believe that it's important to note here that the backlog figures illustrated are for the IT services businesses that tend to be quicker turn, shorter cycle businesses that are more exposed to the short-term impact of the budget turmoil, the sequester, et cetera. And the key takeaway for us here is that the changes in backlog really align with the vendor outlook for most vendors that the remainder of the year is going to become increasingly challenging. Most vendors either stood by their guidance for the year, or the few that did revise their guidance tended to revise it downward. And the changes that we observed in backlog here, and if you were to extend this back a couple of quarters, you'd see a steady decline as well. And that really supports the outlook that 2013 is going to continue to be a very challenging year for most of the companies in our benchmark study. I'll take a moment to orient the audience to the graphic on this slide. And we have another view into backlog here. Here we've illustrated the aggregate total backlog and funded backlog levels for the government-centric firms, once again, the 13 government-centric firms in our benchmark study since 2011. What we have here is the sum of total and funded backlog levels for all 13 companies, all 13 of the government-centric companies. We've literally just summed up their total backlog levels and their funded backlog levels and provided a view into the sequential changes for each of these two types of backlog over the last 2 years. And while seasonal patterns and backlog movement for both of the backlog types of backlog here, while the seasonal movements appear to have been somewhat insulated from the sequester, we typically see a sequential contraction during the second calendar quarter of the year, which is not a departure from what we've viewed in the past. But that said, what we did observe this quarter was that the rates of contraction in backlog levels accelerated over the last quarter, over the last 2 quarters, more than in prior years, and both types of backlog have sunk to their lowest levels in over 2 years. The majority of the firms in our benchmark study tended to have this pattern emerge if we were to break this out on a company-by-company basis. This is something that we tended to see across most of the companies in the study. So once again, we believe that the backlog data here certainly is a reflection of the trend in the trend of revenue contraction, the trend in the environment towards smaller contract sizes, shorter contract terms, shorter contract timelines, the LPTA, lowest price technically acceptable contracting trend that's emerged over the last year or so. The timing of awards and government funding actions during the first half of the year was also a factor. And while we don't project backlog levels for the rest of the year, and we haven't actually received any specific guidance from backlog guidance from our vendors, we do expect a modest increase in the next calendar quarter in 3Q due to seasonal budget flush in the federal space. But we have anecdotal indications at this point that any sequential increase in backlog levels is probably going to be modest. So I'd like to move to the second discussion area today, where we will discuss the factors we observe impacting company margin performance during the second calendar quarter of the year. And we're going to focus on the P&L. We're going to focus primarily on gross and operating margins, as well as on operating expenses as a percentage of revenue, I should say proportion of sales, over the next couple of slides. So the graphic on this page is an illustration of the average operating margin broken out both by quarter and by year for the 13 government-centric IT services providers in our benchmark study. I want to note that we did normalize these numbers by removing significant one-time charges that we didn't believe accurately portrayed the day-to-day operations of the vendors. In addition, we provided an outlook for the third and fourth calendar quarter of 2013. We made these estimates based off corporate guidance that has been provided to us, or our anecdotal guidance that we have received in our conversations with vendors during the last 2 quarters, actually. So the key takeaway here is that going into 2013, the mantra that most companies had adopted was margin performance in lieu of top-line growth, in lieu of an environment in which there was no realistic expectation for a rebound to the growth levels that we've seen over the last 2 or 3 years ago. And the expectation, and we've also factored this into our projections for the remainder of the year as well, is that this mantra, this focus on margin performance, this focus on operational efficiencies, is going to remain in place as the environment is also expected to remain hostile to growth through the remainder of the year. We've observed companies implementing a variety of cost control measures. I'll talk about a few of those some of those in just a few moments. But I want to call out that the data, when we conducted this analysis, the data from the first half of 2013, from the first and second calendar quarters, really says to us that the momentum that companies who appeared to be successful in their efforts to drive margin performance last year throughout 2012, but that momentum appears to have been lost now, or at least it's losing steam with some vendors. In essence, we observed that the average operating margin performance has declined from the 2012 levels, particularly during the second quarter of 2013. And we also attribute this, at least in part, to the impact of the sequester that was triggered at the end of calendar 1Q13. So from there, I want to move up the P&L briefly to talk about the impact that we observed on company gross margins. And we've illustrated that on this slide, where we have a similar illustration to the last slide, where we portrayed average company gross margins in terms of quarterly, as well as broken out over the last 4 years for the 13 government-centric firms in our benchmark study. And the data here, the data on gross margins, suggests to us that company efforts to manage project and employee costs, primarily in the area of managing labor capacity and staff deployment to demand and their overall pipeline levels, were more effective in the sequestration environment than were efforts that were targeting operational expenses. In other words, selling and marketing expenses or overhead expenses that would be booked in directly into OpEx. Once again, we've also provided our outlook for the latter 2 quarters of 2013. We think that there may be some impact on gross margin performance during the second half of the year, primarily in the fourth quarter. And this is because our estimates take into account how companies in our benchmark studies tend to, during the fourth calendar quarter of the year, increase activities around selling in I should say in terms of business development, and how the third calendar quarter budget flush can include orders for product-based components that impact some of the vendors in the benchmark study. There's also the realization of performance-based milestones on existing contracts that could have an impact. And then the employee impact of the ramp-up of awards won during the third calendar quarter can have an impact on employee costs during the fourth calendar quarter. So all of those things in aggregate, we believe, may have an impact during primarily the fourth calendar quarter of this year in terms of gross margins. But once again, we didn't see the impact at the gross margin level that we did on the operating margin level, which suggests to us that companies have been effective in aligning their employee costs to the challenges in the environment. So on this chart, we've broken out the average operating expense. We've moved back down the P&L, and we didn't find the answer that we were looking for in gross margin, so the only place left for us to look is really in terms of operating expenses. So what we portrayed for you here is the average operating expense and average operating expense as a percentage of revenue for the 13 government-centric vendors in our benchmark study. And as I mentioned earlier, many of these vendors have undertaken initiatives to reduce their cost structure, including facilities and physical footprint consolidation, headcount rationalizations in areas such as support or administration, business unit reorganizations. An example of that would be Raytheon's business unit consolidation earlier this year. Other efforts such as supply chain automation were observed within the vendor set that we follow. And while these certainly did provide cost savings within their targeted areas, we believe that many of these cost savings were ultimately offset by an increase in sales-related costs. in essence, the companies in our benchmark study had no choice in the environment but to make greater commitments and greater investments in their business development function and the business development activities. Certainly some of the elements in the market environment that were impacting that were the extended sales cycles, increasing competition for a decreasing number of opportunities in primarily the federal space, and what we're getting a sense that there's an increasing disconnect between agencies and vendors, specifically between business development people and professionals in the companies that we follow and their counterparts, their purchasing counterparts in federal agencies and departments. So the key takeaway here is that as many levers as companies have been pulling on in terms of operating expenses to manage to the environment, the almost mandatory increase in investment in terms of business development has finally caught up with them, at least in terms of their operating expense structure. So the final discussion area for the presentation today will focus on some of the actions taken by vendors during the quarter to reposition for growth and hedge against the continued turmoil in the federal space. And I'll talk about a number of areas that, and call out some vendor examples in terms of things like alliances and acquisition activity, new service announcements, as well as shifts in market focus. And then we'll wrap up with a quick view in terms of the outlook, the growth outlook for the remainder of the year. So one of the things that we've been observing, not just during the second calendar quarter of the year, but over essentially the last year to even 18 months, with the competitors that we follow in the public sector market, is an increased focus on expanding into international markets. Several of the companies that we follow have been increasing their activities outside of the U.S. During the second calendar quarter, we've got 3 vendors called out here. General Dynamics recently reorganized its UK operations and announced a pair of awards that we believe are, at least in part, attributable to that reorganization. They also announced a deal win in the Singapore market. Lockheed Martin launched its Lockheed Martin International Group, which will spearhead its efforts to expand outside the U.S. And one of the key strategies that it plans to employ to do that is to expand its strategic alliances in international markets. And then Northrop Grumman continued to be active in the Australian market. And one of the common threads that we've seen across the vendors that we have observed engaging in more international activities has been the leverage of their capabilities in cybersecurity, in information assurance, in biometrics, border security. So the security area in general has been what companies have been using as the wedge to break into new markets outside the U.S. In terms of portfolios, we saw a number of companies make investments in areas, and the common threads in terms of investment areas were the healthcare, IT arena, cloud computing, cybersecurity, and analytics. We have 4 vendors called out here for actions that they took during the quarter in those areas. General Dynamics, for example, plans to hire or plans to increase its scale in terms of delivery in low-cost onshore locations, primarily with regard to its Medicare and Medicaid programs. I believe that they're planning on adding between 5,000 and 6,000 staff across 6 locations in 6 call center locations in the U.S. In terms of the cloud space, The limited number of vendors that have received FedRAMP authorization expanded during the quarter with I believe there were a handful of other vendors as well that joined this kind of exclusive club. But we noted CGI as a vendor who joined the FedRAMP club during the quarter. We've seen them coming up on the respective radars of several of the companies that we follow. We've received inquiries about their activities, and they're starting to gain the attention of competitors in the space. In terms of healthcare IT, HP had a major award announcement with their $220 million award to create and install a Medicaid management information system for the state of Indiana. This engagement will also have HP providing support services for 4 years after the system is implemented, and represents a continuation of HP's 20-year relationship as the state of Indiana's primary Medicaid fiscal agent. And then finally, and this overlaps with obviously with the acquisition area, but Raytheon acquired or continued to be acquisitive in the cybersecurity and analytics space with its acquisition of Visual Analytics. They were viewed by Raytheon as being a natural fit for their cybersecurity and analytics portfolio because of their experience delivering solutions not only domestically but to international public sector agencies. And I believe that they're also looking to leverage Visual Analytics commercial exposure to expand their cybersecurity customer portfolio. In terms of operational actions or actions taken to realign operations, SAIC continued to move forward with the split with Leidos, and part of that larger strategy is an effort to divest non-core businesses. During the quarter, they divested themselves of I believe this was a product business or a business that was focused on developing products around explosive and weapons detection, and they deemed it to be outside of the core competencies of their NSS group. And we expect that this isn't going to be the first and only such action taken by SAIC as they move forward to operate independently of Leidos, and when the split is finally completed, we may see additional similar actions. L3 Communications, they rebranded their aircraft modernization and maintenance business line as Platform and Logistics Services during the quarter, and we think that we didn't observe a similar reordering of the portfolio in the former AM&M group, so we think this is more or less the first step towards perhaps a more formal reorganization of the group going forward, and perhaps a consolidation of the portfolio, a simplification. And then Raytheon continued to execute on its corporate restructuring by moving the headquarters for the recently formed Intelligence, Information, and Services Group to the Sterling, Virginia area during the quarter. One of the things that we noticed more so during the second calendar quarter of 2013 than we had in previous quarters was an increase in alliance activity, an increase in activity around forming partnerships. We saw this kind of overlap also with the effort to expand into international markets. We've called out CACI and Booz Allen Hamilton here as establishing alliances with companies outside the U.S. market. We are aware, for example, that CACI's partnership with Be Informed will enable them to, or at least give them access to more markets in the continental Europe area. Booz Allen Hamilton continues to execute on its strategy of expanding in the Middle East, and we believe that the alliance that was announced with Turkey-based company Havelson is in cybersecurity is an example of that. I'll skip down to Dell for a moment. Dell continues to execute on its strategy of aligning itself with vendors and partners in the big data and analytics space. Specifically in this quarter, we noted the alliance with Apixio in the healthcare arena. We expect that Dell will leverage its new partners' capabilities in big data and analytics and machine learning capabilities to really enhance its own portfolio of higher margin offerings for the healthcare sector. And I purposely skipped over CSE's announcement of their partnership with AT&T. I wanted to talk about that last because we saw that as a really a major development over the last almost the last year in terms of alliance activities. This is a big splash in the market. Where now CSE and AT&T are going to go to market and co-develop and jointly market cloud solutions not only for public sector but also for commercial clients. So we see this as a big step forward for CSE to expand its cloud capabilities. Or I should say to enhance its cloud capabilities. Specifically in terms of portfolio investments, many of the same themes, many of the usual suspects in terms of investment areas continue to be the focus for companies: cybersecurity, analytics, and cloud. 4 vendors noted here. Mantech introduced a pair of new security solutions: Responder Pro 2.1 and Active Defense 1.3. We believe that these new solutions will help Mantech to expand its capabilities in both public sector and with commercial clients. In terms of other cybersecurity solution introductions, we've noted General Dynamics here, who also introduced a pair of solutions in the cyber arena, primarily to expand their portfolio serving federal clients. In the analytics space, we noted the introduction by Xerox of its merged solution, which is a centralized analytics-based parking system for local governments. Xerox continues to expand its portfolio in the transportation and state government areas, and this is consistent with that element of its growth strategy. And then Unisys introduced its stealth solution for Amazon Web Services, which we view as being an effort by Unisys to position itself to capitalize on cloud and to leverage its partnership with AWS and kind of piggyback off of AWS to provide Unisys with new avenues for growth in the cloud arena. With regard to merger and acquisition activities, we didn't observe a market increase in M&A activity during the quarter. That said, we didn't observe a significant decrease. The pace of M&A activity has remained somewhat modest over the last 2 or 3 or 4 quarters. We think that certainly the environment is a cause for that. The difficulty and the challenges doing accurate valuations of acquisition targets has certainly impacted the pace of M&A activity. But we did note during the quarter, Lockheed Martin acquiring Amber Group to expand its IT solutions in the across public and energy and transportation verticals. I already mentioned Raytheon and Visual Analytics. IBM expanded its capabilities in cybersecurity and fraud detection with the acquisition of Trusteer. And then one of the most notable, in our view, acquisitions was Accenture's acquisition of ASM Research, really positioning, or I should say a continuation of Accenture's strategy to expand further into the federal market. They reorganized about a year ago, and this is what we view as being just the next logical move and next logical step for Accenture to continue to expand into, primarily with this acquisition, into the DoD, into the Veterans Affairs areas. So the final slide today is a view into the outlook for the remainder of the year. This is the projected growth rates for the entire calendar 2013 year for the 20 vendors in our benchmark study. And the outlook, the data that we have here, suggests that for all but two companies, and those two companies being Xerox and Accenture, the outlook is for another year of revenue contraction. And for many of these companies, this is going to be the third straight year where they've seen their revenue base contract. Xerox and Accenture have insulated or deflected some of the pressures in the federal space because of their more diversified portfolio focus, their more diversified geographic focus, their focus in the healthcare space, which kind of overlaps also with their respective focus in the state and local areas. But for the vendors, for the contractors that have primarily the U.S. federal government as their client, the remainder of 2013 looks to be continued to be challenging for those vendors. So finally, I just want to make a few comments about the public sector practice and where we plan to, some of the areas that we're going to continue to look at, and some of the areas that some of the emerging research areas. We're certainly going to continue to follow the vendors and the 20 vendors in our benchmark study in terms of tracking their revenue growth, what the drivers behind their revenue growth and margin performance are, what are the strategic actions that these companies are taking to adapt to the marketplace, how are they going to be leveraging alliances and acquisitions to meet their strategic objectives, how companies are managing their human resource growth, and what new segments, and this will be primarily where we'll focus on areas like cloud and analytics and cybersecurity, what new segments or new markets, new geographic markets are vendors targeting for growth. So I'd like to thank you for joining us today, and I'd like to open the floor at this time for questions.
Great, thanks, John. Excuse me. Thanks to those of you who sent through your questions. We had a couple in queue, so please, any questions, send them through now. The first question, guys, we have is, you mentioned cloud as a key investment area for some contractors in your presentation. Only a limited number of firms have so far received FedRAMP certification. Why do you think that is?
Well, first of all, thanks for the question. While FedRAMP certainly put in place processes and procedures to streamline the vendor approval process by standardizing security assessments, and several of the vendors that we follow have indicated that the FedRAMP has in fact made the process less onerous. Many of these same vendors have also suggested that the overall process remains expensive and time-consuming, and that the security requirements remain very rigorous, and these things in total have made it challenging for them to achieve compliance. Now, that said, prior to the government shutdown a few weeks ago, we did expect to see the number of contractors joining the FedRAMP club increase as we move through the end of 2013 and through 2014. However, now with the budget turmoil exacerbated by the shutdown, we believe that there may be significant disruptions not only in the FedRAMP certification process, but the overall pace of federal cloud adoption. I personally believe that agencies are still kind of treading lightly in the cloud arena, and they remain somewhat hesitant to utilize cloud solutions for more than just basic IT needs like email or collaboration. Though we have no doubt that the federal government's commitment to remain strong to moving forward aggressively with the implementation of cloud solutions wherever and whenever possible. Certainly many of the impediments to growth that I mentioned earlier, tight budgets, limited resources, sequestration, are not only acting as headwinds to growth, but The flip side of that coin is that those same factors are driving federal IT decision makers to explore new ways to accomplish their mission objectives and budget goals, and it's making the business case for clouds more compelling.
Next question we had, you mentioned healthcare-related IT as a growth area for vendors, but the momentum seems to be mostly in the state and local markets rather than the federal space. What are you seeing happening on the federal side?
Well, thanks for the question. Certainly the growth leaders that we highlighted earlier have benefited from their focus on and their activities in healthcare-related markets, primarily in the state government space, as well as the international space. I'll call out Accenture as an example. They were one of the growth leaders, and their acquisition of AMS Research kind of is an indication to us that one area of opportunity in the federal space, or a pair of opportunities will be in the DoD and in the VA. Primarily for modernization work. I think an indication of that would be the projected budget increase in the VA in fiscal 2014. I believe is going to be between 10 and 15% over 2013 levels. And then the DoD recently reached out to the vendor community, expressing its interest in having them showcase their electronic health records capabilities. And this kind of indicates to us that there is a desire in the DoD to accelerate modernization work to replace legacy systems over the next year. However, we can't lose sight of the impact of the sequester and the ongoing turmoil in the budget process, and this is certainly putting the squeeze on the amount of investment capital that many agencies can earmark and have available for modernization initiatives. And much like I mentioned in the cloud space, we believe that this will likely restrain healthcare-related IT spending growth in the federal space through most of 2014.
Okay. Looks like we have one more question, so if anybody else has any questions, please send them through now. The last question we have right now, guys, is what are your thoughts on CACI's acquisition of 6-3 Systems?
Well, technically that acquisition happened in the fourth calendar quarter. Sebastian,
clarify.
Comments there?
I have a few. Certainly, I would caution that it has not been finalized yet. There's an agreement in place, but we still need to see it through the process. Secondarily, to that it's an interesting shift. CACI is a very acquisitive company by nature. It's a major pillar of its business strategy and its growth strategy. More recently, they've been looking at business systems-based companies, and to go into 6-3 Systems with its more engineering and C4I focus was an interesting shift, particularly given the contracting revenues in the DoD space. Additionally, it was, I believe the first reported price was $820 million for the company, which is expected to have 2013 revenues of about $470 million, which puts it at about a 1.7 multiplier, which is a bit aggressive, particularly given that a lot of it is related to an area where we expect to see continued funding pressures on the defense side. But it's an interesting play. CACI certainly has a reputation, well deserved, for integrating acquisitions well. So it's going to be an interesting wait and see. My initial thoughts to wrap it up are it's bold, it's expensive, but I'm not necessarily bearish on it. I think there's a lot of long-term potential there.
Mm-hmm. I agree, and just a couple of final comments on that. I think that the acquisition really represents that CACI has its eye on the long term versus the short term. I mean, certainly there's going to be short-term impacts in terms of profitability, but we really looked at this when we did some deeper analysis in terms of the portfolio for 6-3 Systems. As well as some resource management analysis, we believe that this is a high-quality acquisition that is going to add more lucrative revenue streams that CACI was willing to pay a premium for.
Okay, we have another question. Do you see a turnaround in the market at any point in the future?
In the future, yes. In the immediate future, no. I think 2014 and the feeling we've gotten from vendors that we've spoken to in the space is expect the same thing in 2014 that you saw in 2013, especially given that we still technically don't have a finalized federal budget. The government is still technically shut down unless something's happened over the course of the hour we've been here. So until those issues are ultimately solved and the issue of sequestration is solved, it's going to be a long road. Profitability is going to continue to be lower than historical averages. I don't see revenue losses year to year being as strong, largely due to a low base effect. So we'll probably see lower single digits through calendar year 14. And at this point, it's likely going to be in calendar 15 that we see any kind of return to normalcy in any way, shape, or form.
Mm-hmm. And we know that many agencies and departments right now have already kicked off their fiscal 15 planning, and we have indications, anecdotal indications, albeit, that they're looking at anywhere from a 5 to 10% across the board decrease. Some of that obviously is going to change as we move forward, but the general consensus is that IT spending levels are going to be lower in 2014, in 2015, or at least the IT spending environment in federal fiscal 15 is going to resemble 2014 and even 2013.
One thing to add to that, too, is that whereas IT services, due to the short cycle nature of procurement relative to any kind of, let's say, defense procurement, it tends to run shorter cycle, which means it's more immediately impacted, but it should also bounce back quicker once there is money to be had again, because agencies can't continue to keep pushing off their modernization efforts, their refresh cycles indefinitely. It needs to happen at some point sooner than later. So I think as soon as the budget situation is resolved, again, likely calendar 15 before we see anything there, you'll see the IT services spend bounce back pretty strongly.
Looks like we don't have any other questions in queue, so I want to thank everyone for sending through your questions, and thanks you, John and Sebastian, for the presentation and answering those questions. As I mentioned, you can follow John, Sebastian, and TBR at the Twitter handles listed here. And unfortunately, we're missing the slide share on YouTube pages, but we can send those to you if you reach out to us to get that information. Before you sign off, I'd like to ask you to take a brief survey about today's webinar. 3 quick questions. How valuable did you find the presentation? How good did you find the presenters? And if there's other topics or comments that you have, now's the time to send those through. We are using that feedback quarter to quarter to improve and fine-tune the direction of our presentation, so any input you have would be great. I'm going to leave the chat function open for another couple of minutes in case there's any last-minute follow-ups or questions you may have. And if we don't hear from you in this go-round, we look forward to speaking with you all again next quarter for the next iteration of this presentation. Thanks, everyone. Have a great afternoon.